here with you this evening. And then I'm in a debate with a coworker about whether these are called kazoos or squawkers. But whatever you want to call them, if you would grab them, and then you can help me introduce. All right, we'll bring up Carly. So without further ado.
Good job, y'all did great. You did great. Oh, that's supposed to be me, I don't know. Let's skip that one. Thank you, Emily. Okay, so I usually, when I do the State of the Economy, I usually, kind of a couple of days before it happens, I say a little prayer that God will make the stock market really good, either the day or day before. I don't know, so it didn't happen for me this time. So the stock market, actually, 2019 was a great year. Yeah, that's fantastic. Our portfolios did extremely well. We outperformed the S&P 500, and we had some portfolios that did really, really well. So 2019, great year. We actually had portfolios that were returning 35, 38, 40%. So 2019 was a great year. And 2020 starting off a little bit rocky-ish. So we have a couple things going on. One is right now, I think what's affecting the market and dropped it down by 600 points on Friday was the coronavirus. Not the beer virus. So it's corona because the word corona means crown.
She's planting seeds.
And the virus, when you get it under a microscope, kind of looks like crowns. Like the coronavirus. Now, in the United States, no one has died from that. 5 cases confirmed. Seems like the CDC has good control over it over here, but China has had 7,000 cases, and I think somewhere around 200 have passed away, but most of those haven't died from the virus, they've died from pneumonia. So, and it's maybe people that were already in kind of a weaker state before they got the virus. So, I heard somebody on TV the other night talk, it was a medical doctor, and he was saying, so, and I fly a lot, so I'm starting to see people wearing the masks. So we're investing in those companies that make those. But this guy was saying that 5 confirmed cases, and now we're starting to see masks being worn. But there were last year there were 20 million confirmed cases of the flu. So sometimes it's the media that can really hype this stuff up, and because it sounds good, it's good sound bites. If it sounds scary, then more people are going to be watching the shows, more people will be paying more money for commercials, all of that. So we have to kind of clear away the fog a little bit to see what's really happening. And so we don't think that the coronavirus is going to have a very long or a very large impact on the market. But, the market usually overreacts, and media typically also overreacts. So this one should settle down. Here's the 4 key things we're going to be talking about tonight. So we have interest rates and inflation, and then we're also going to be talking about the global tensions. We have a few of those. And GDP, which is gross domestic product of the United States, all of our output, and then we're going to give you a little stock market outlook from here.
Sorry.
So, interest rates, the Federal Reserve met recently, and so the Federal Reserve is the one that can try to raise or lower interest rates. They can do it with, or the banks, what the banks have to pay, they can't do it, all of us, just individually. But if they raise it on the banks, then the banks generally will raise it on us, but not always. So, the Fed had a meeting, and what did they decide? Yeah, keeping it the same, So we have a record low interest rates right now, and mortgage rates just hit a record low again. So 30-year mortgage, 3.65%. So if people are thinking about getting a mortgage, I don't know, great time to do it. Because you can lock that in, and then over the next 30 years, there will be times when the money market accounts will be paying more. So, and it's fixed. So a 30-year fixed rate also on a mortgage helps you fight inflation, because now you have a certain percentage of your expenses that you aren't going up for 30 years. So these are little tools that we can use, but that's a great one. Interest rates are staying where they're at. Fed is kind of saying they're probably going to keep them that way for a while. So that's a good thing for the stock market. And then inflation. Let's talk just a little bit about inflation. This is a graph of what they call 1-year rolling inflation. So if you look at July 2019, 1.8% is the inflation rate from July of 19 back to July of 18. And then you can see the next month, the rolling rate. So this is giving you an idea maybe though that inflation is picking up a little bit. It's 2.3. So yeah, it's not bad at all. It's pretty steady. So, but if that one starts jumping up quite a bit, that's one reason the Fed might say, okay, maybe we need to raise interest rates to try to control this a little bit. So we don't go back to what happened in, what years were those? 80s, 70s. So in the 70s, the average inflation rate per year for a 10-year period was 8% a year. Whoa, stuff was going up like crazy. On your little card there, it shows what the price of a house was in the 1920s. Did anybody see that? Price of a home? $1,298? Yeah. Oh my goodness. So, but now there's still people alive that were in the 1920s. And so when they look at the price of a house now, yeah, and they have that reference point from way back then, it can be a little scary. Okay, so inflation now we think is not doing that bad. And this is a little graph that is telling, so inflation is an average number, so there's some things that inflation is higher on and some things that inflation is even negative. So this is for the last year. If you look at that chart there, where it breaks even, so the inflation rate is on the bottom, 0% is the middle line, and then 2%, 4%, and 6%. So this tells us that for the last year, the highest inflating products were tobacco and smoking products. So see, we can control that, right? So that's what my grandfather, when he was 89, and the price of a can of Skoal went over 25 cents, he said, that's it. Quit. Okay, so we can control that inflation rate a little bit. The second one down, that's also about a little over 4%, that one is, one we don't like to see up there, medical care. So that one is really, we don't want to see that, because that's going to, eventually, if that keeps at the rate it's been, these 4, 5, 6% rates, that's a huge medical expense coming down the road, which won't help us with our Medicare and the Medicare premiums. Down on the bottom, we actually had something that was almost negative 4%, so price went down, and that was utility and gas service. So price went down, gas service. And also down about 1.5%, the next one up there, was fruits and vegetables, so that's why we asked them, could we have a little more veggies tonight on the buffet line? So fruits and veggies, there you go. So get after that. Prices actually went down. Okay, so that's a little bit about inflation. Now, global tensions. Well, we have the trade war with China and some of the tension going on with Iran, back and forth a little bit. Seems to maybe have settled down, but definitely that one can ignite at any time. Yeah. This is a little bit about the trade war, and one of the things, and this is the trade war with China. The blue dots, this is over time, but the blue dots are United States putting tariffs on China, and the bigger the dot, the bigger the tariff. So the big blue dots were $200 billion worth of tariffs that we put on them, and those two big blue dots were September of 18 and May of 19. And then you see at the very top, it's July 2018, we put on $34 billion in tariffs, that's when it started. And then they came right back and put $34 billion on us. Tit for tat. Is that okay thing to say? Okay. I forgot. Okay, I guess it is. I don't know. It's just an old expression. August of 2018, then we put on $16 billion, they put on $16 billion. So then we put on $200 billion. They didn't have $200 billion to put on us. They only could put on $60 billion. That's when the pressure started hitting them a little bit. And in May we put on $200 billion. They didn't have any retaliation. And then finally they came up with some retaliation, $60 billion in June of 19. And then they started coming to the negotiating table. Now, one of the things we were watching last year and into the election is that all of the trade wars that were going on. Of course, we had Mexico and Canada, that all got worked out. And but when those were first starting, the market would drop, reacting. Oh, this is terrible. It's going to be horrible. The market would drop. And we would always have the opinion that those were going to get worked out. And whether you hate them or love them, President Trump, we felt like, would be a good negotiator when it comes to these tariffs. So that was why we started positioning your portfolios with stocks and companies that would do better if the tariffs got worked out. And we started seeing it happen, so that was one of the reasons our portfolios were doing better. And then on the big one with China, we were having an investment meeting and talking. So, and the question was, when is President Trump going to work that out? Because we felt like if he could work it out just kind of right before the election, maybe August of 2020, that would be really good for his reelection, and the market would jump. But maybe that was too long, because then people might lose some enthusiasm getting there. So we're wondering, well, maybe he would try to do it in early 2020. Or maybe even might try to do it in late 19, and we really just couldn't figure out when he was going to do it. That would be the best for his election. And you all know what he came up with? 3-phase trade war. Some in late 19, some early 2020, and some a little closer to the election. So we're watching that, and we're like, okay, this is going to be good. It's going to be good for the stock market and stocks. And started happening. So we got phase 1 done. And under phase 1, China agreed to lighten up on some of this intellectual property that they've just been ripping off our patents and things. And we eased up a little bit on some of our tariffs that we put on them. And so that was a good start, and now we're moving forward on that. So we still think the tariffs will continue to improve, and this will get worked out, and it's going to be good for the market as it continues to make those steps. So we're watching that. Gross domestic product, GDP. They look at that quarterly, so that's the output of the United States, goods and services and everything that's being produced, and they look at it quarterly, and generally it's considered, if it's around 2%, or if you want a better, a little more closer. Okay, so generally, if it's around 2 or a little better, that's considered good. And since 2016, it's been kind of running around 2. We had one quarter 4 of 2018, that it dropped. By the way, that was not a very good quarter. Market was down a lot that quarter, but then it came right back up, almost 3%. Now it's been hovering in 2019 around 2, and that's all good. So that's it, and that's good for the market. So we are watching that. And profits are good. Companies' profits is also what we're watching, because if they're making good money, they're going to produce more, sell more goods and services are going on out there. One company that we've been watching and waiting, because we own them in our tech stock portfolio, to have a good profit announcement and earnings, finally did just recently, and that one was Amazon. So Amazon stock was up 10% after they announced their earnings. So Microsoft looking good and announcing good earnings, so that the bigger companies are announcing good earnings, so that's also good. We like that. These are what we call leading economic indicators. This screen maybe is a little boring, so that's why green or red. Okay, green means good, red means not so good. And so that's kind of a gauge that we're watching, but some of those on there, the 10 and 2-year Treasury yield spread. So that if the 10-year Treasury pays less than owning a 2-year Treasury, so if you could get more for a 2-year Treasury than a 10-year, that's not good. They have a name for that. And what do they call that when that happens? Inversion. That's an inverted yield curve. Because the yield, as you go through time, should get higher. So a 2%, a 3-year should be higher, a 4-year should pay you more, 10-year. If those flip, that's bad. That happened, and that happened towards the end of 2018. And so we had an inverted yield curve, which is supposed to signify a recession and all kinds of things. And that didn't happen, but if you go back in history, it never happened, because it happened during the day and fixed itself before the end of the day. And all the historical numbers are just for the day. So, but it's getting a little better, so that means, okay, maybe that we don't have to worry about that one. Good, so these are just what we're looking at, and why I'm showing you some of these leading economic indicators is that for 2020, our belief is that the stock market we're probably going to see another 15, 20, 25% increase between now and the election, which would be incredible after these big increases we've already had. So, and there's a lot of reasons, and President Trump has a huge incentive to make that happen too, because that helps get him reelected. So we're just going to try to be on those coattails. And but now we're trying to decide, when do we actually get out of the market? Because one of our concerns is that if an October surprise happens, and that would be during a presidential election time, what can happen is an opposing presidential party can all of a sudden, and why they do this in October, it's a big surprise. It's something usually really bad about the opposing candidate. And they do it in October because there's not enough time to figure out that it's not true before the election hits. Because if they did it in September, then okay, fact checkers could go and find out and say, no, this isn't true. And then the election could be normal. So that's why they call it the October surprise. They're all trying to get it out there in October. And so we had that happen during the last election, and that was against President Trump. But in October, the surprise was the big Russia thing, and it was like he was with some hookers or something in Russia and some nasty stuff, and it ended up not being true. But they found that out after the election, but it didn't end up affecting the election, but it could have. People could have just said, it's just too much weirdness, so, but it didn't happen. But I think it could get even worse now. And that's what I'm a little bit concerned about, October of 2020. So if the market is up 20%-ish in September, our current plan is to just sell the stocks and go to a money market account. And ride, kind of be on the sidelines for October. And then right after the election, decide what we want to do, and then we'll be getting back in, depending on what happens. If something happens and a Democrat gets into office, generally the market will have a negative reaction because, it's change. And the stock market doesn't like change. What's going to happen now? Are the taxes going to go back up on businesses, and that's going to create problems? So if President Trump gets reelected, I think the market will probably have, over that next week or month or so, a nice little upside again. So we'll get right back in maybe the day after the election. So, but we're also watching these leading economic indicators, because if the market is up 20% in July and all of these start turning red, that's another reason why we might even scoot out a little early. So, I'm going to jump to this screen because that kind of is a little bit about what I'm just talking about now. So there are reasons why we would get out of the stock market and just go to a cash position. So most firms would be what's called buy and hold. So get maybe a mixture of bonds and stocks, and then you just keep that. And when it goes up, you enjoy it. When it goes down, you don't enjoy it. So you make money, and then you lose money, and you make money, and you lose money. And over time, that can get extremely annoying. Because it's like 10 years I have my money in there, and now, what's up, then I lost it, up, then I lost it. So we don't necessarily believe in just buy and hold forever. So there are reasons we would go out of the stock market, and these are the key three. Number one is a systemic failure in our financial system, and that would be something like 2008 in the mortgage crisis. Whoa, that's an obvious thing that's going to shake down all of the companies in the stock market. We'll take a loss, which might be 5% on a portfolio, but just to get out and then ride it out. When the market comes back. 2008, it took about 3 years for the market to get back to where it was. But that's one reason we would look at potentially getting out of the market for a while. Second is an event driven. So that would be what I would call a black swan event. Whoa, something weird just happened, like Twin Towers. Whoa. We would just pull out of the market for a while until we figure out what's going on. And another event driven thing, coronavirus. So we have an investment team, and we're on the phone when those things are happening, because that's number two. We might pull out of the market. And if we felt like it's coming over to the U.S., they can't control it, could be a year or two before they have a vaccination, people are going to be dying, we would get out of the market for a while. That's event driven. So we are watching that. And then number three would be a pronounced overvaluation. That means stocks are way higher than they should be and just have to correct. Does anybody know when that happened last time, a major one? 2000. So .com. That was the .com bust. The .com bust, all those stocks were up so high, they weren't even making money. And I can't remember the economist's name now. He came up with that a new term for that. Does anybody remember what that term was? No. He called it irrational exuberance. This is just weird because if you remember, it was like spiked up and none of these companies were making money. So he's like, this is irrational exuberance. So if we hear that, we're getting out. We don't like irrational exuberance. So here is just a, I'm going to come back to that previous screen, but here's a little bit about how we would determine, is the market really, really overvalued, because there's been so much happening with the market in 08, way down, comes back up, it's been up good since 2010, up, and the media every time likes to hype. Stock market hits all-time high, like that's something you need to be afraid of. So how do we clear the smoke and decide, is the market really way up and we need to be careful? So I have what I call the 8% rule. And what I like to do is go back about 30 years when the market had a little normal period, which was August of 1990, and the S&P 500 was at 327. And then I like to go 30 years and see where the S&P 500 is now. And in August of 19, 30 years later, S&P 500 was 2,918. Now, one way you could think about that, that's a basket of 500 stocks. It's got all kinds of calculations to normalize it. But you could just say that could be one company's stock price, 327, and 30 years later, that stock price is $2,918. So it was up. How much is that? So if you go back and you say, well, if this grew by 8% a year, stock market averages over 10% a year. But if it grew by 8% a year, where would it be to give us some way of giving us perspective? And it would actually be at 3,046. And where is it now? Friday? Does anybody know? S&P 500. I'm going to wait till somebody checks their phone. 32.25. I know some of you have that on your phone.
32.25, Carl.
32.25? 32.25 on Friday. That's so it's that would mean it's a little bit over 8. So that might make that about an 8.2% return over 30 years. If we were looking at that number and it was 4,500, then that would be cause for concern. Could be irrational exuberance. So right now we don't think so. This chart is the chart of bull markets and bear markets over time. A bull market is a good market, growing a lot. A bear market is bad and either shrinking or staying about the same. The purple is the bear markets. So if you look at the biggest one, the 25-year segment there, that was 1929. By the way, this little celebration tonight for the 20s, this is for the beginning of the 20s, okay? I had to point that out to somebody. This is the beginning of the 20s, but in 1929, yeah, look what the 20s did. Look at that chart, it was up 300% over 5 years. But then we had the big drop, the Great Depression, and it took 25 years, over an entire 25 years, that the stock market was up 1.69%. That's like buying a 25-year CD, paying 1.69%. 25 years, not per year, over the whole entire period. And so have we been, so you also hear on the media a lot, when can this bull market has to end? It has to end. Well, you can see with the bull market on the end, that's the gray one, that's the one we're in now, really kind of starting 2009, 10-ish. And really has not been that long, and it's up now maybe 130, 140% over that period of time. Back in the 1980s and 90s, that other gray one, 17-year period, the stock market was up over 1,000%. And so people that were kind of already had all their money in about 1982 have been working, saved and saved, and then we're getting close to retirement, man, their money grew like crazy over the next 20 years, 1,000%. So we've only grown on this bull market maybe 140%. That was the end of 18. So also that looks to us like there's nothing alarming happening there either. So again, we're just trying to clear the smoke a little bit, see what's really going on. Because also now I think the media has some incentives, even based on elections, to try to make a good thing sound bad or make a bad thing sound good. So we have to be able to clear the smoke and try to figure out what's reality. Okay? Somebody have a good video on that? Boom, boom, boom. All right. So our summary here is the state of the U.S. economy is good. We think it's good. Maybe not great, but it's good. It's good. Growth has been slowing a little bit, but it's still that GDP was over 2%, which is good. And earnings are good, so we're happy there. So we expect there's still some life left in the bull market. And but our reasoning more likely for getting out in September-ish is because of just the October surprise. If this were not an election year, we probably would be thinking we're going to stay right here. So, all right, next is questions. Yes.
So, if Donald Trump gets impeached, how does that affect the trade war?
So he said if Donald Trump gets impeached again, how would that affect him? So he did get impeached by the House, so he has been impeached. Now the Senate decided not to. So he's good there, but if they try to impeach him again, at this point we don't feel it's got. It was amazing when it went to the Senate. We expected the market might react a little bit negatively to that, but it didn't at all. So it doesn't seem to have the impact, I guess maybe that the Democratic side is wanting to have. It doesn't seem to be having an impact. And maybe that's too because it's not just like flashing like you did this wrong, you broke huge laws, and it's not extremely obvious, and it could appear to be a little bit political. So maybe that's why the market was just saying, no. Yeah.
If you look at the data, it was impeached by the House. The next day, the market went up.
Okay, market went up after he was impeached by the House. Well, see, the market likes it when nothing happens in Congress. So, they're going to be dealing with this for a while, and that's good. Keep them out of everything else. Other questions? Yeah. So the question was, do we leverage of companies, how much do companies have borrowed? We might even look to that as a country too. How highly leveraged are we? You know, I would say to me one thing, I have a banking background, so I worked in banks for quite a long time. I started a bank, I ran a bank, and so I'm a little bit sensitive to a lot of debt, but President Trump, that's something that bothers me a little bit, is he likes debt. And you know, that's his history, is debt helps. You know, because if you're in real estate, high leverage can make you a lot of money. High leverage, that means if I'm gonna buy $1 million property, if I use $900,000 of somebody else's money, and I can get that at 4 or 5%, and I use a little bit of my money, the return, if the return is 20%, I just made 15% on somebody else's money. So leverage for President Trump. He sees debt way differently than what some of the rest of us do. But the question was leverage. Companies are leveraged. They were highly leveraged in late 90s. Also, margin accounts started happening where people were borrowing against their stocks to buy more stocks because of irrational exuberance. We are making so much. So there became a lot of leverage, which then was a big problem when everything unwound. So we're getting some higher leverage again. That really is not that's not what causes generally the tipping point, but it can be a reaction to it. So I don't know if I would be concerned just from that alone, but I might be concerned. That would be one of the reasons why if something triggers something that maybe is a systemic issue, then we get out of it. So don't really see it just right out there. Yeah, so if the Feds raise the rate because everybody's borrowing really low, the country's borrowing low, if those rates went up a lot, that would be extremely scary. That could be a reason too we would get out of the market. Yeah.
So at the beginning of this year, we had the Secure Act come into place, probably as much because we've got the largest transfer of wealth intergenerationally that's ever happened in the country. Are there any methods to avoid having to liquidate inherited IRAs, funds within that 10-year period?
Yeah, let's talk about that for just a minute. So Scott is talking about Congress just enacted a new law called the Secure Act. And I really think it did three key things. It did a lot of little stuff too, but its impact was on retirement accounts. And one thing that it did was when you all turn, someday, some of you in the room may eventually turn 70 and a half, okay? When that happens, right now you had to take money out of you were forced to take a required minimum distribution in R&D, even if you didn't need the money, now you got to pay tax on it. They increased that age from 70 and a half to 72, which really, I mean, it's good, right? It bums me out though, because I like the half thing, 59 and a half, 70 and a half. I had my wife convinced I got to celebrate half birthdays, 7 and a half. I don't know, I can't give her that story. But they moved it from 70 and a half to 72. So if you're not 70 and a half at the beginning of the year, you can wait another year and a half before you're forced to take it out. That was a good thing, but then they did I think probably a not so good thing. And that is, so when you inherit an IRA, let's say from maybe your parents, not from a spouse, okay? If you inherit an IRA from a spouse, nothing has changed there. It just becomes your IRA and nothing changed. But if you inherit an IRA, it's not a spouse. Right now, that's called a beneficiary IRA, and you can do this thing called stretch. You can stretch it out and take the money out over your lifetime. So you only have to take a much smaller amount. They changed that, and so the stretch IRA went away, and now when you inherit an IRA, you had to take all the money out in 10 years. And Scott was talking a little bit about that because, they see that there's going to be a lot of that happening. And so this change they made is really a good deal for the government. They're going to get taxes faster. But not so good for people inheriting IRAs. And the 10-year period, they don't spell out, you have to take 1/10 a year or anything like that, like they used to do. It was based on age, not that anymore. So if you don't take anything out for 9 years, in the 10th year, you have to take all of it out. And that could put you in a huge tax bracket. You might be paying 50% tax on it. So you gotta be careful. And if younger people are inheriting an IRA, now, if they take out a 10th each year, they're in a higher tax bracket because they're making money. So now you have to look at strategies like, well, does it make sense then to do things like, well, one is don't take anything out until you retire, and if that's 5 years later, then the next 5 years take out 2/5 each year. Or should the parents as they're living, should they be doing Roth conversions? Because they're in low tax brackets, maybe they should be converting it to a Roth, so when the children inherit it, it's not near as big a deal. So that's going to be a lot of tax planning and a lot of change that's going to impact people. If you already have a beneficiary IRA, it didn't change. That didn't change, so it's still going to be the same. And then the third thing they did was, when you turn 70 and a half, before you could not put money into an IRA. You had to stop putting money into an IRA. Now they said there's no cap on the age. No matter how old you are, you can still put money in your IRA. You just have to still earn money. So if you earn money, you can put money in an IRA even at 75, 80. And so one of the things you can do, if you hit 72 and you don't need the money out of your IRA, and you're still working, you could be forced to take money out, but then you could turn right around and put it back in and not have to pay the tax on it. So that's a fun little strategy. But if you can't do that because you're not working, then the strategy there is then just have your spouse go to work. When you do, yeah. When you roll the money into the Roth, the taxes have to be done immediately, so if you're dealing with the parents on that, they need to do that very strategically over multiple periods of time. Yeah. And especially if they're in some sort of nursing home situation, they might have huge tax write-offs. It would be a great time to be rolling and converting IRAs to Roth IRAs, and sometimes paying no tax. And you could totally miss that opportunity. So, yeah, be watching. Yes. So you can, just asking, if you take the money out, you're forced to take it out, are there ways you can reinvest it and protect it from taxes a little bit? Yes. Yeah, there are. So there's some strategies out there, but they're going to be very individualistic. So you have to have a very good financial advisor. And you have one. All right. Okay. Oh, and she's cute. Oh, it's not me. And she's cute. That's good. All right. Okay, so what do I got, Tony? Am I going fishing for a minute? All right. So don't forget to the bar's gonna be open, and the pictures back here if you want some 20s pictures. Also, we're gonna try when I'm done fishing here, we're gonna get everyone to the front of the room that has 20s outfits on. We're gonna take a big group picture. Tony, come on up. What are we doing here? Hey. So Tony said, I'm gonna just repeat what you said. So Lori and Tony put together the awesome centerpieces based on the time frame. They got some really cool stuff there. And then what? There's coin on the table. There's some coins on the table.